some money to the issuer. And that is the number we need to figure out, is this number that goes right here. It goes the opposite direction of all of these cash flows. And to do that, we're going to take the present value of all of these cash flows taken at the market rate of interest. So we use the stated rate to figure out the cash flows. We use the market rate to do the present value of the future cash flows. So we're going to do the present value of the $1 million. And we're going to bring it back 6 periods, because of 1, 2, 3, 4, 5, 6 periods. And the interest rate per 6-month period is how much? 6%. Very good. So the market rate is 12% annually. So for these 6-month periods, it's 6%. 1/2 of that. So 6% is the discount rate we're going to use. And that is going to give us a present value factor of 0.70496. So you can either use your calculators or you can use tables. So for the exam, I will give you tables if you want to use them. Otherwise, you can use your calculators, and that's just fine as well. And this is going to give us a present value of this guy of 704,960. We also need the present value of all these $50,000 each. We could take each one individually and add them all up, or we all know how to use the present value of an annuity, right? We're all okay with that? Okay, that's my assumption that you all know how to do that. So we're going to do the present value of an annuity, 50,000. There's going to be 6 periods, again 6% per period. So we're going to take 50,000, and when we get the present value of an annuity factor, we're going to get 4.91732. If any of you do have issues with time value of money stuff, I'm happy to help you before or after class, or at our break today. I can talk you through some of this. Multiply those two together and we get 245,866. Add those up and we get 950,826. Okay, so 950,826 is the present value of the cash flows brought back at the market rate of interest, or the effective rate of interest. This is the amount that if our investor invests 950,826 right here, and then receives these cash flows, she will get a return of 12% on her investment. That is the only number that will give her exactly a 12% return. And so that is going to be the cash flow at the issuance. So, and I'll put this in brackets just so you know that's the opposite direction of all of these guys. So at issuance, 950,826 is the amount of money that's going to go from the investor to the issuer, and then these are the cash flows that are going to come back the opposite direction. Is everybody pretty clear on that? All right, so for Lauren, the issuer, she's going to receive cash, that guy right there, of 950,826. At the same time, leave a space here, we're going to have a credit to bond payable of $1 million, the face amount. And then the difference is going to be a discount on the bond of the difference, which is 49,174. So for the issuer, what kind of an account is this discount? What kind of an account is that right there? Nope. Good guess. Interest. Not interest. All right, you're concerning me now. What kind of an account is that discount account? Liabilities. Close. Liabilities aren't normally debits. Contra liability is the answer. This is a contra liability. It's contra to which account? Bond payable. Very good. So if we were to look at our balance sheet right after we did this, What would we see on our balance sheet? We would see the difference between these two numbers as a liability, because the carrying value of this bond is the difference between these two numbers, which in this case is 958.26 as of right now. And that'll change. So the bond payable minus the discount, that's the liability. Does everybody understand that? Contra liability is what that guy is. All right, now we'll do the journal entry for the investor. For the investor, they're going to pay out cash of $958.26. They're going to debit an investment of $1 million. And they're going to credit a discount of $491.74. All right, so hopefully you see that these are mirror images of each other. We have a bond receivable and a bond payable, just on opposite sides, same amount though. We have a cash inflow, cash outflow, the same amount. And in both cases, we have a discount, one's a debit, one's a credit. So for the investor, what kind of an account is this discount account? This one is a contra asset. Okay, so back when you learned about discounts in your first class, you always said a discount was a contra liability. At least that's what you should have said. But now you see that it's both. It could either be a contra asset or it could be a contra liability, depending on who you're talking about. It goes both directions. All right. Any questions so far? This problem continues. All right. Determining interest, the effective interest method. Interest accrues on an outstanding debt at a constant percentage of the debt each period. Interest each period is recorded as the effective market rate of interest multiplied by the outstanding balance of the debt, as well as the carrying value during the interest period. So interest is recorded as an expense to the issuer and revenue to the investor. So the next thing we're going to do is we're going to record the first interest payment that happens on June 30th. So in other words, this cash flow right here, okay, right there, we're going to record that. So on that date, the issuer is going to pay out cash of $50,000. And at the same time, because of the effective interest method, they're going to record interest expense equal to the carrying value of the debt multiplied by the market rate of interest multiplied by the time period. So now we're going to do that. So what is the carrying amount as of right now? $950.826. It's the difference between the bond and the discount. You can look at it for either one. It's the same number for both. So it's going to be, as of right now, $950.826. That's the carrying value, multiplied by the market rate of interest, which is 12% annually, and then the time period, which is 6 divided by 12. And that is going to give us our interest expense, which is going to be $57,050. So for Lauren, the issuer, they're going to record interest expense of $57,050. All right, but our interest expense and our cash are not equal. Right? So what does the difference go to? It reduces our discount. Very good. We're going to amortize our discount. Amortize means reduce. We're going to reduce our discount. So in this case, it has to be a credit to make this thing balance. And so we're going to reduce it by 7,050. Or another way of seeing this is, up here for the issuer, we're the issuer right now, we created a discount by debiting it. We created this contra liability of $49,174. From here on out, we're never going to debit this account again. We're only going to reduce it. So from here on out, we're going to credit it to reduce it. Another way of saying this is, well actually, before we do that, so when we reduce this discount account, what happens to the carrying value? It increases. Get rid of the contra liability, and the carrying value of the liability goes up. So another way of saying what just happened is, we incurred interest expense of $57,000. But we had just paid out cash of $50,000. We didn't pay out enough. So our liability increased. How much we owe increased because we didn't pay out enough in cash. That's the intuition you should probably use. It helps. Questions on that? Should I take your quiet as understanding or confusion?
Yeah, I have a question. The balance of 850, 826, that's at the end of the first 6 months?
850, 950, this guy?
Yeah,
This is the
we
initial
doing-
amount we put in,
okay.
so it's this guy minus this guy, and we haven't changed it. So when we get to this tape, it's still that amount. So we have the bond payable of $1 million minus the discount of $49,174. That equals $950,826. Nothing has happened since we did this journal entry. So when we get here, it's still $950,826. Did that help?
No.
It did not? What number do you want it to be? I can negotiate.
Just let me think about it for a while.
Okay.
You said the discount rate increases the carrying value?
Yes, so the amortization, or in other words, the reduction of the discount increases the carrying value.
And why is it?
So if you get rid of the discount,
Right.
so we now have less discount. The discount is no longer going to be reducing the carrying value as much. So it gets bigger.
Okay.
Does that help?
No, yeah, I understand.
Okay.
That's only for the users.
Yes, we haven't talked about the investor side. It's just going to be the opposite of what I just said. All right, so we'll do that. For the investor side, they're going to be receiving cash of $50,000. They're going to be recording interest revenue of $57,050, and they're going to be reducing their discount by $7,050. Okay, let's think about for them. For them, they created this contra asset, which was a credit, and now we've reduced it by $7,050. What does this done to the carrying value of the asset? Increased it, right? So this investment is now worth more to them. Why is it worth more to them? Well, because they earned this amount, but they only got cash of this amount. So the issuer is going to have to pay them more money because they didn't pay us enough right now. So the investment account increases in value. Okay? All right. We haven't got to the hard stuff yet. We will. This will actually probably help some of you. So now what we're going to do is we're going to, that information we were just talking about on the previous page, we're going to put it into a table, which is going to help us see what happens to this bond as we go through our 3 years. And what you're going to see is that every line on here, after maybe the first one, is going to be a journal entry. It's going to look just like the one we had on the previous page, but the numbers are going to change. All right, so amortization schedule for a discount. And we'll come back to this idea that I have printed right there. Let's go ahead and start filling out our table first. So at issuance, which was 1109, our carrying value was $950,826. So if you're the issuer, this is the bond payable minus the discount. If you're the investor, it's the asset minus the contra asset. Either way, this is the carrying amount for both of them, either the asset or the liability. $950,826 to start out with. That first journal entry we just wrote down on the previous page happened on 6/30/09. We had a cash payment of $50,000, as you saw, right? We either debited or credited cash, depending on who we are. The interest expense and the interest revenue was $57,050. And how did we get that number? We took this number, multiplied by the market rate of interest, and then the time period, and we got this number right here. And then the difference between these two, which is 7,050, reduced our discount for both people. So these three numbers are the numbers that we had on the previous page in the journal entry. 50,000, 57, and 7. So 50,000, 50,000, 7, 57, obviously 50s. And then the same thing for both of them. So this line that we have right here represents the journal entries we just did on the previous page. For this table anyways. Obviously don't write out the table for the exam, you'll get it wrong. Give me journal entries on the exam. All right, so after this journal entry, what's the new balance here? Or at least how do we figure it out?
You had the, discount.
We add our discount, right? So for both parties, the discount increased the carrying value of either the asset or the liability. And so take this plus this, and we have our new balance of $957,876. So that is our new carrying value of either the bond, payable, or the investment. 1231.09 is our next payment. How much cash are we gonna pay out or receive on that date?
$50,000.
$50,000. So that stays the same number. Is this gonna stay the same number?
No.
No, it's not. Why is it not gonna be the same number? The carrying value changed. So how are we gonna figure out this number? I'm going to take 957,876, and I'll write this up here just this one time. 957,876. We're going to multiply it by the market rate of interest, which is 12%. By the way, the market rate of interest has changed for this firm, but we don't care. We're still using the same market rate of interest we figured out at issuance. So this 12% doesn't change. Even if the current market rate of interest on this date is now 15%, it doesn't matter. We're still using the issuance market rate. And we will for the life of this thing. Multiply this by 6 divided by 12, and that's going to give us 57,473. 57,473. The difference between these two is going to be the amount of discount we amortize, which will be 7,473. All right, we now have these three numbers. If I were to ask you what are the journal entries on 12/31/09, you would do these exact same journal entries as these guys right here, but with those new numbers that we just figured out on the table. Does that make sense? So it's still going to be 50, and then it's going to be 7,473 and 57,473, and the same thing, those numbers are going to change. But the journal entries are exactly the same, just with new numbers in them. And then the new carrying value changes because we just got rid of this discount, and the new one is 965,349. Hopefully by now you've figured out our pattern, and we're just going to continue this. So we're going to have 630, 10, 12, 31, 10, 630, 11, 12, 31, 11. These are all the same numbers. Our cash payments are always 50,000. We saw that in our picture. They're going to be 50,000, 6 of them, same number every time. So in the journal entries, the cash payments stay the same. Always going to be 50,000. The interest expense, or the effective interest, will change because this carrying value changed. So to get this number, we're going to take 965,349, multiply by 12%, multiply by 6 divided by 12, and we get 57,921. Take 50 minus that, we get 7,921, a new carrying value, etc. And I'll just write the rest of it in here. You get the idea. Incidentally, there's probably a finance class that you do a lot of this in. Is this true? How many of you have already taken that finance class that does a bunch of this stuff? Raise your hand. Well, only a couple of you. It's a required course though, right?
Yes.
All right, so one thing you should notice is that this interest rate is increasing each time. Why? Because the carrying value is increasing this time. What does it increase to? It increases to the carrying value by the end. This is not an accident. This is on purpose. It always does this. This is the amount you have to end up with at the end, because when we get to 12/31/11, I'm going to go ahead and record this journal entry plus the journal entry to pay back the face amount. So I'll record this guy right here at the very end so you can see it from both perspectives. So just like we had before, For our issuer, we're going to debit interest expense, or in this case, it's $59,434. Last time it was something less. We're going to reduce our discount. We're going to pay out cash of $50,000. The discount's going to be $9,434. When we get to that, our discount is now gone. We have just got rid of the last of our discount, and so there's nothing left in our discount account. What's left in our bond payable account? The original amount we put in. We've never messed with the bond payable account. We originally put it on our books for $1 million, still then $1 million, never changed. The only thing that's changed is this discount, which is now gone. So when we get to this point, we make our last cash payment of $1 million, and the bond payable goes away. And we are done. Everything is tied up nicely. Is where it's supposed to be. Similarly, for the investor, is going to receive a cash payment of $50,000, just like every other time. Going to reduce the discount by $9,434. It's going to record interest revenue of $59,434, and then it's going to receive cash of $1 million, and it's going to get rid of their investment. $1 million. So we didn't write down every one of the payment journal entries, but from the table, you know what they are. They're the same as these guys, but with those numbers on those dates. And so we have the initial issuance, we have all of the payments for interest, and then we have the maturity payment here at the end. Any questions on any of that? That is a bond issued at a discount. No questions? Let's go ahead and take about a 10-minute break. It's 8:40. We'll start again at